and welcome back to Tax Chats looking at international taxation. In today's episode, we're going to be looking at intercompany financing. Now, intercompany financing is a real hot topic at the moment. It's one of the key focus areas from an ATO perspective. It's also had some changes in legislation, looking at transfer pricing, as well as thing capitalization. So intercompany financing really looks at debt equity mixes and how those are priced. So when we're looking at a debt equity mix, previously the 60% Safe Harbour was quite commonly applied because that was consistent with our thing capitalization rules under the Safe Harbour method. There are other options, but that was probably the most common. Under the new rules, there is no Safe Harbour. It really falls under the transfer pricing provisions, and that means the taxpayers of any size really should be assessing what their debt equity mix should be and whether the debt component is supported under transfer pricing principles. The thing capitalization rules will instead focus on a 30% EBITDA test. The terms and conditions of the debt should also be considered. So this will look at the interest rate, but there's also a number of other rules that are relevant. So in terms of interest rate, the ATO has provided some simplified guidance, and that's to help taxpayers with low risk or low materiality type transactions, and they give it an updated interest rate each year, and that's included in PCG 2017-2, the simplified transfer pricing documentation options. So if you're unsure about what rate, that's a really good starting point for you. The other thing to think about is all the other terms and conditions of the financing. So they're going to give rise to either an increased or a decreased interest rate, and that's going to obviously govern the ATO's risk profiling of that debt interest. So things like the term of the loan, the currency of the loan, any guarantees in relation to the loan. So all of these kinds of factors are included in the ATO's risk rating assessment tool, and that's in PCG 2017-4. So it's a really useful guide for taxpayers to gauge their risk in respect of those financing arrangements and understand what level of scrutiny they're likely to get from the ATO. So a low risk transaction will generally obtain a lower level of scrutiny, where a high risk transaction, you really should be getting more support to support that transaction in the event of an ATO review. And given it is a focus area, it's probably a recommended best practice to get that support in place. So there are a few little tips and tricks on what's going on in the intercompany financing space at the moment. Let me know if you have any questions, and I look forward to seeing you in our next tax chat.